Hi, this is Rob. We're going to look today at how changing correlation can impact the range of probable outcomes using the Quantifiable Edges correlation tool. So this is a little bit different than I looked at last time. It's a real neat look at things too, I think. So to do this, what I did is I set up the same two models or same two strategies as the first demo. Each model has a 10% expected compound annual growth rate and a 20% expected volatility. And then we just made them 50-50 within the portfolio. The difference this time is we're going to look at all trials, not just the single median path. So let me switch over and I'll show you how we do that. Well, here's the tool. And right here, we can see, rather than choosing median path, which we had last time, I chose range of outcomes. Now, the setup is as I mentioned, but the correlation between them right now is almost 1. So what we see is that the blend is basically the same as either of the sample portfolios because of the fact that they move in lockstep. Looking at these whisker charts, the boxes are the middle 50%, so anything from the 25th percentile up to the 75th percentile is shown there. And then the whiskers show the results down to the 5th percentile and up to the 95th percentile. So that's what you're looking at in those charts there. What's so interesting about correlation here is that as we reduce the correlation, what you see is not only does the median get higher and higher, but the range gets tighter and tighter. So we get down to around a 0 correlation here. You've got a substantially smaller range and a better median outcome. If we go to almost fully inverted correlation, now you see you got a real tight range and a much higher probable outcome. In fact, the bottom of that range is above the median for the other two. So that's impressive. So bottom line is, if you've got multiple strategies and they're all highly correlated, you're looking at a gamble and probably not as much upside. But if you've got low correlation, or even better yet, inverse correlation, you're going to get better upside potential and a tighter range. So higher median, lower spread, basically better odds and less volatility the lower the correlation is. I hope you find these videos interesting. I do have several more to do, so I'll be sharing more and more about this tool with you. It is free. You can get on Quantifiable Edges and play with it yourself. All you need is a login. If you don't have one already, just click on Correlation Tool and sign up there. Thank you.